Reminiscences of a Stock Operator by Edwin Lefèvre. Book summary in English. Hey, powerbooks community. Get ready to dive deep into a true classic of finance and psychology. This isn't just a story. It's a timeless lesson in mastering the markets and yourself. Today, we're breaking down Edwin Lefèvre's Reminiscences of a Stock Operator. Follow the legendary Larry Livingston's, based on Jesse Livermore, wild ride through the early days of Wall Street. From bucket shops to fortunes made and lost, this book reveals the unchanging principles of speculation. We'll unpack Livingston's hard-won wisdom, chapter by chapter, the power of patience, the danger of tips, the crucial battle against your own emotions. These lessons are as relevant today as they were a century ago. Whether you're a seasoned trader or just starting your journey, this book is a must-read. Join us as we unlock the secrets to not just beating the market, but to understanding the human heart that drives it. Stay tuned for our full, chapter-by-chapter breakdown of Reminiscences of a Stock Operator. Don't forget to like, subscribe, and hit that notification bell for more powerful book summaries. Let's get started. Part 1. The Rise of a Boy Wonder. Chapter 1. The Rise of a Boy Wonder. In the opening chapter of Edwin Lefèvre's Reminiscences of a Stock Operator, we're introduced to the legendary Larry Livingston, the fictionalized Jesse Livermore, not as a grand Wall Street titan, but as a quiet, observant boy plunger working in a Boston bucket shop in the late 19th century. From the very beginning, Livingston displays an almost uncanny knack for numbers and patterns. His job involves marking prices on a large board, but his mind is constantly at work, noticing the tiny, seemingly insignificant fluctuations in stock prices. He starts to see that these movements aren't random. There are often consistent patterns before a stock moves significantly. He begins to make mental predictions about these movements, and much to his surprise, he's frequently right. Driven by this emerging insight, he makes his first small wager, a bet on the price of Burlington stock, with a fellow clerk, and he wins. This small victory ignites his passion for speculation. He realizes he has a unique gift for reading the tape, the ticker tape that conveyed real-time prices, and understanding the rhythm of the market. This initial discovery of his innate talent for observation and prediction sets the stage for his extraordinary, yet often turbulent, career in the world of speculation. Key takeaways. Here are the crucial lessons and insights from Chapter 1 that your audience should grasp. 1. Innate talent and observation. Livingston's journey begins not with formal training, but with an inherent ability to observe and interpret market data. He saw patterns where others just saw numbers. Actionable for viewers. Develop your observational skills. Don't just look at charts. Try to understand the story they are telling. 2. The power of the tape. Before advanced charts and algorithms, the ticker tape was the primary source of real-time market information. Livingston's mastery came from understanding its nuances and rhythms. Modern relevance. While the tape is gone, the principle remains. Understanding price action, volume, and order flow via modern tools is paramount. 3. Small bets. Big discoveries. His initial entry into speculation was through tiny wagers with fellow clerks. These low-risk experiments allowed him to test his theories without catastrophic consequences. Actionable for viewers. Start small. Test your strategies with minimal capital, or even paper trading, and learn from every trade before scaling up. 4. Learning is continuous. Even at this early stage, Livingston wasn't just gambling. He was learning. He was actively developing his system by trial and error, identifying patterns, and making predictions. Actionable for viewers. Approach trading as a continuous learning process. Every trade, win or loss, offers a lesson. 5. The allure of speculation. This chapter perfectly captures the excitement and intellectual challenge that draws people to the markets. Livingston found a deep satisfaction in his ability to anticipate price movements. Thought provoker. What truly fascinates you about the markets? understanding your motivation can help sustain you through inevitable challenges. Chapter 2. Mastering the Bucket Shop Game. In Chapter 2, Larry Livingston has fully immersed himself in the world of bucket shops, becoming incredibly adept at their unique game. He has refined his tape reading skills to such an extent that he consistently wins against these establishments. His method isn't just about predicting big moves, but about recognizing the precise timing of small fluctuations that the bucket shops, with their fixed betting odds, can't sustain against a truly skilled operator. His persistent winning streak, however, eventually makes him a pariah. Bucket shops, designed to profit from the public's losses, quickly identify him as a threat. They begin to refuse his business, literally throwing him out or making excuses not to take his bets. This forces him to constantly find new bucket shops, often using disguises or different names, just to continue trading. This chapter highlights his early triumph over a flawed system and the inevitable resistance he faced from those who couldn't beat him fairly. Key takeaways. 1. Profiting from systemic flaws. Livingston exploited the inherent weaknesses and fixed odds of the bucket shop system. He understood their mechanics better than they did. 2. The power of precision timing. His early success was built on exceptionally precise timing of small price movements, demonstrating that even minor fluctuations, if correctly anticipated, can yield consistent profits. 3. The consequence of consistent winning. If you're consistently beating a system not designed for you to win, expect resistance. Livingston's success led to him being blacklisted by nearly every bucket shop. 4. Adaptability and persistence. Being barred from one shop after another forced him to be adaptable, constantly seeking new avenues to trade and showing remarkable persistence in pursuing his passion. 5. Early glimpse of discipline. While not explicitly stated as such, his ability to consistently profit in these environments required a form of self-discipline to stick to his method despite the lure of larger, riskier bets. Chapter 3. The First Foray into Wall Street. In Chapter 3, Larry Livingston, having thoroughly conquered the bucket shops and exhausted their willingness to take his bets, decides to take his refined system to the true battlefield of finance, Wall Street. He heads to New York with a substantial sum, confident that his proven methods will translate directly to the larger, legitimate exchanges. However, he quickly discovers that the dynamics of Wall Street are fundamentally different from the fixed game of the bucket shops. The market is not controlled by a single entity setting the odds. It's a vast, fluid environment with real forces of supply and demand. His finely tuned sense of small, predictable fluctuations, which brought him such success in the bucket shops, proves inadequate here. He finds himself repeatedly caught on the wrong side of trades, losing money rapidly. This chapter marks his abrupt and painful realization that conquering one type of market does not guarantee success in another, and that the lessons learned in limited environments may not scale up. It's a humbling and costly introduction to the complexities of the big leagues. Key takeaways. Market environments differ. Success in one trading environment, for example bucket shops, does not automatically transfer to another, such as the New York Stock Exchange. Each market has its own unique rules and dynamics. 2. The scale of the game. Wall Street's legitimate exchanges involve much larger forces and a truer reflection of supply and demand, making precise, small-scale predictions far more challenging than in a manipulated system. 3. Overconfidence is a pitfall. Livingston's initial confidence, built on his bucket shop triumphs, led him to underestimate the new challenges and to misapply his strategies, resulting in significant losses. 4. Learning from losses is crucial. This chapter illustrates the critical lesson that losses are often the most effective teachers. His painful Wall Street debut forced him to re-evaluate his entire approach. 5. The need for adaptation. To survive and succeed on Wall Street, Livingston would need to fundamentally adapt his strategies and develop a deeper understanding of genuine market movements beyond simple tape reading. Chapter 4. Wall Street's different game. Having faced a brutal introduction to Wall Street in the previous chapter, Larry Livingston continues to grapple with its unforgiving nature in Chapter 4. He is still struggling to reconcile his bucket shop expertise with the realities of the legitimate exchange. He attempts to apply his old tactics, looking for quick, small profits based on minor tape fluctuations, but these prove to be entirely unsuitable for the larger, more robust movements of the New York Stock Exchange. He discovers that Wall Street's game is not about predicting minute oscillations, but about identifying and riding much larger, sustained trends. The market doesn't care about his small bets. It moves based on significant forces of supply and demand and the collective psychology of thousands of participants. He realizes that a true market cannot be beaten in the same way a bucket shop can be. This chapter deepens his understanding of why his old methods failed, emphasizing the need for patience, broader perspective, and a fundamental shift in his approach to speculation. He's learning the hard way that to make money on Wall Street, one must trade with the prevailing forces, not against them. Key takeaways. 1. Distinction between actual markets and gambling dens. Livingston firmly establishes the difference between the legitimate, fluid market of Wall Street and the rigged nature of bucket shops. One is a true reflection of supply and demand. The other is a controlled environment. 2. Small fluctuations versus major trends. His bucket shop success came from exploiting minor, predictable price changes. On Wall Street, he realizes profit comes from identifying and aligning with significant sustained trends, not trying to scalp tiny movements. 3. Patience is paramount. This chapter subtly introduces the critical need for patience. Trying to force trades or anticipate every small move on Wall Street leads to losses, underscoring the necessity to wait for clear, large-scale opportunities. 4. The market is never wrong. A core lesson emerges. The market's current price is always right. Traders must adapt to what the market is doing rather than imposing their own opinions or expecting it to conform to their prior assumptions. 5. The cost of misapplied strategies. Livingston's continued losses highlight the dangers of trying to apply a successful strategy from one context into a completely different one without proper adaptation or understanding. Each market requires its own specific approach. Chapter 5. Lessons from the School of Hard Knocks. Chapter 5 finds Larry Livingston still enduring significant losses on Wall Street, learning firsthand the brutal reality that the market often extracts a heavy tuition fee. He recounts how his repeated attempts to use his bucket shop strategies in the legitimate market consistently backfired, leading to substantial financial setbacks. These painful experiences, however, are not in vain. Instead of becoming discouraged, Livingston views these losses as invaluable lessons. He begins to understand that speculating successfully on Wall Street isn't about outsmarting the tape with lightning-fast small bets, but about patience, waiting for confirmation, and recognizing the larger forces at play. This chapter emphasizes that true mastery in speculation comes from learning from every mistake, analyzing why trades went wrong, and internalizing these costly lessons to prevent future errors. It underscores the idea that often, the most important education in trading comes from the market itself, through the School of Hard Knocks. Key takeaways. 1. Losses as tuition fees. Livingston emphasizes that losses are an unavoidable, albeit painful part of the learning process in speculation. They are the cost of gaining essential market wisdom. 2. The importance of self-correction. Instead of blaming the market, he meticulously analyzes his mistakes, trying to understand why his strategies failed on Wall Street. This self-assessment is crucial for growth. 3. Patience over action. He begins to realize that impatience and the urge to constantly be in the market are significant contributors to losses. Waiting for clear, larger opportunities becomes a nascent understanding. 4. Recognizing market context. The stark contrast between bucket shops and Wall Street reinforces that successful strategies are highly context-dependent. What works in one environment will not necessarily work in another. 5. Foundation for future discipline. While still in the learning phase, the lessons from these hard knocks lay the groundwork for the discipline and emotional control that will define his later success. Chapter 6. The Pitfalls of Impatience. In Chapter 6, Larry Livingston continues to recount the painful lessons learned during his early struggles on Wall Street, focusing specifically on the devastating impact of his own impatience. Despite having accumulated significant capital from his bucket shop days, he finds himself repeatedly losing it because he cannot wait for the market to clearly declare its intentions. He recognizes a pattern. He often gets the market direction right, but his eagerness to jump in too soon or to exit too quickly consistently eats away at his profits or turns potential gains into losses. He begins to understand that the biggest enemy isn't necessarily the market itself, but his own human emotions and psychological impulses, particularly the desire for immediate action and the inability to sit idly by. This chapter is a crucial turning point where Livingston starts to internalize that simply being right about a stock's direction isn't enough. Timing, patience, and emotional control are equally, if not more, vital for profitable speculation. He vividly illustrates how hope and fear, fueled by impatience, can destroy a well-reasoned trade. Key takeaways. 1. Impatience as a major trading foe. Livingston explicitly identifies impatience as a primary reason for his early losses. He emphasizes that being right too soon is often indistinguishable from being wrong. 2. The cost of doing something. He highlights the common urge to constantly be active in the market, even when there's no clear signal. This action bias leads to overtrading and unnecessary losses. 3. Waiting for confirmation is key. The chapter strongly advocates for waiting for the market to confirm one's view before entering a trade. Acting on anticipation, without confirmation, is extremely risky. 4. Emotional control is paramount. This chapter solidifies the idea that controlling one's emotions, hope, fear, and impatience is more critical than any technical or fundamental analysis in successful trading. 5. Understanding market rhythm. He recognizes that markets don't move constantly or predictably in small increments. There are periods of waiting, followed by periods of clear movement, and patience is required to capitalize on the latter. Chapter 7. Recovering from the Brink. In Chapter 7, Larry Livingston recounts a period of severe financial distress following his repeated losses on Wall Street. Having depleted his capital, he is forced to return to the only arena where he knows he can consistently make money: the bucket shops. This is a humbling experience for him, a step backward from his ambition to conquer Wall Street. However, it's also a pragmatic decision driven by necessity. He uses his mastery of the bucket shop game to methodically rebuild his capital, demonstrating his incredible resilience and ability to operate profitably under specific conditions. This phase isn't about grand speculation. It's about disciplined, systematic accumulation of funds. Having replenished his trading account, he once again sets his sights on Wall Street, but this time he's armed not just with capital, but with the painful, yet invaluable lessons from his past failures. This chapter underscores his determination, adaptability, and the vital understanding that sometimes one must retreat to a safer, known environment to regroup and prepare for future battles. Key takeaways. 1. Resilience and adaptability. Despite devastating losses, Livingston shows remarkable resilience. He doesn't give up, but instead adapts his strategy by returning to a known profitable environment to rebuild his capital. 2. The importance of capital preservation and rebuilding. This chapter highlights the absolute necessity of having sufficient capital to trade effectively. When capital is depleted, the focus must shift to rebuilding it through reliable means. 3. Learning from past mistakes, reinforced. His return to the bucket shops is not a sign of failure, but a strategic retreat, demonstrating that he has genuinely learned from his Wall Street fiascos and is now applying prudence. 4. Strategic retreat. Sometimes, the best move in trading is not to fight the market when it's going against you, but to step back, reassess, and only re-engage when conditions are more favorable or when you have a distinct edge. 5. Patience and methodical approach. His systematic accumulation of capital in the bucket shops, without ego or chasing quick riches, exemplifies a patient and methodical approach to wealth building. Part 2. The Evolving Speculator on Wall Street. Chapter 8. The Power of the Big Picture. Having rebuilt his stake, Larry Livingston once again returns to Wall Street, but this time with a profoundly altered perspective. Chapter 8 marks a significant shift in his understanding of the market. He recognizes that his previous failures stemmed from focusing too much on minor fluctuations and attempting to scalp small profits, a strategy suited only for the limited scope of bucket shops. He begins to grasp that true, substantial profits on Wall Street come from identifying and trading with major price movements, the big moves that unfold over days, weeks, or even months, driven by powerful underlying forces. He learns the critical lesson of waiting for the market to confirm its direction, and then having the patience and conviction to ride the trend for as long as it lasts. This means letting go of the urge to catch every small up and down, and instead focusing on the broader picture. He articulates the idea that a stock never goes up or down merely by virtue of its ticker symbol, but moves because of fundamental conditions and the collective actions of many participants. This chapter is pivotal as it outlines his transition from a nimble boy plunger to a burgeoning master of long-term trend following. Key takeaways. 1. Shift to major trends. Livingston fundamentally changes his focus from short-term scalping to identifying and profiting from significant, sustained price trends. This is where the real money is made on Wall Street. 2. Patience for the big move. He learns that waiting patiently for the market to confirm a strong direction, rather than jumping in prematurely, is essential. The biggest profits come from sitting tight during these large moves. 3. The market as a macro entity. He gains a deeper understanding that the market's movements are not random, but are driven by underlying conditions and the collective psychology of many, making it impossible to outsmart on small scales. 4. Letting profits run. This chapter implicitly introduces the concept of letting winning trades run for substantial gains, rather than cutting them short for small profits, a crucial element of successful trend following. 5. Beyond the tape. While tape reading remains valuable, he realizes it must be integrated into a larger framework that considers broader market forces and the long-term direction, moving beyond mere price action. Chapter 9. Understanding the Human Element. In Chapter 9, Larry Livingston delves deeper into the psychological aspect of market behavior, particularly the irrationality of the general public. He observes that while markets are driven by supply and demand, these forces are heavily influenced by human emotions, primarily hope, fear, and greed. He realizes that the average lamb, the retail speculator, consistently loses money, not because they are unintelligent, but because they allow their emotions to dictate their actions. Livingston notes that the public tends to buy enthusiastically at the top of a rally, driven by greed and the fear of missing out, and sell in panic at the bottom of a decline, driven by fear and the hope that prices will rebound if they just wait a little longer. He contrasts this emotional decision-making with the disciplined, detached approach required for professional speculation. This chapter is crucial for understanding that market prices don't always reflect intrinsic value, but often mirror the emotional swings of the masses, offering opportunities for the astute and patient observer. Key takeaways. 1. Emotional drivers of the market. The market is significantly influenced by collective human emotions: hope, fear, and greed. Understanding these psychological forces is as important as understanding financial data. 2. The public's predictable behavior. Livingston identifies predictable patterns in how the general public reacts to market movements. For example, buying high out of greed and selling low out of panic. 3. Avoid the crowd mentality. Successful speculation often means acting contrary to the emotional crowd. When everyone is optimistic, caution is warranted. When everyone is fearful, opportunity may be present. 4. Discipline. Over emotion. This chapter reinforces the idea that emotional control is paramount for a speculator. Detachment and adherence to a logical plan, rather than succumbing to impulses, lead to success. 5. Exploiting psychological vulnerabilities. By understanding the public's emotional patterns, a disciplined speculator can position themselves to profit from the irrationality of the masses. Chapter 10. The importance of pivots and timing. In Chapter 10, Larry Livingston introduces and elaborates on one of his most crucial concepts: pivotal points. He defines these as specific price levels that, when reached or broken, confirm a market's direction or signal a reversal. These are not arbitrary numbers, but represent moments when the market's underlying forces are truly declaring their hand. He emphasizes that successful speculation isn't about guessing what a stock might do, but waiting for the market to definitively show what it is doing. Livingston explains that once a pivotal point is confirmed, the market tends to move rapidly in the indicated direction, offering the opportunity for significant profits if one acts decisively. Conversely, if a stock fails to hold a pivotal point, it suggests the prior trend is exhausted or reversing. This chapter highlights the critical role of precise timing in entering and exiting trades, based on objective market signals rather than emotional impulses. It's a foundational concept in his strategy, allowing him to capitalize on major moves while minimizing exposure during uncertain periods. Key takeaways. 1. Pivotal points as confirmation signals. Livingston's pivotal points are key price levels that act as objective confirmation of a trend's validity or a reversal. They remove guesswork from entries. 2. Patience for confirmation. It's vital to wait for the market to decisively break through or hold a pivotal point before acting. Acting prematurely, before confirmation, is a common and costly mistake. 3. Timing is crucial for profitability. Precise entry and exit timing, based on these pivotal points, maximizes profit potential by getting into a confirmed move early and avoiding reversals. 4. Minimizing risk. Trading only on confirmed pivotal points helps to minimize risk. If a stock fails to perform after passing a pivotal point, it's a clear signal to exit the trade quickly. 5. Letting the market lead. This concept reinforces the idea that the market itself provides the signals for action. A speculator's job is to observe, identify these signals, and then act with discipline, rather than imposing their own will. Chapter 11. The danger of opinions and tips. In Chapter 11, Larry Livingston forcefully addresses one of the most perilous traps for any speculator: acting on outside opinions or tips. He recounts numerous instances, both his own and those of others, where relying on information from brokers, acquaintances, or inside sources led to devastating losses. Livingston makes it abundantly clear that genuine success in the market comes from independent thought, diligent observation, and trusting one's own analysis, rather than blindly following someone else's advice. He explains that tips are usually late, often driven by the tipper's own vested interest or lack of true understanding, and almost always lead the recipient astray. True market wisdom, he argues, cannot be outsourced. A speculator must develop their own convictions based on what the market tape, or price action, in modern terms, is showing, not on what someone else claims to know. This chapter serves as a stern warning against the seductive but dangerous siren call of easy information. Key takeaways. 1. Independent thought is paramount. Successful speculation requires forming one's own judgments based on objective market analysis, not on the opinions or advice of others. 2. Beware of tips. Livingston strongly warns against trading on tips. They are unreliable, often late, and can be motivated by agendas that don't align with the recipient's best interest. 3. Trust your own analysis. Develop confidence in your own ability to read the market. Disregard outside noise and focus on what the market is actually doing, rather than what someone thinks it should do. 4. No shortcuts to success. The chapter implies that there is no easy path or secret formula to market success through outside information. It requires hard work, discipline, and constant learning. 5. Taking responsibility. By relying solely on one's own analysis, a speculator takes full responsibility for their actions, which is essential for learning and long-term growth. Blaming others for a bad tip prevents self-correction. Chapter 12. Trading with the trend, not against it. In Chapter 12, Larry Livingston solidifies one of the most fundamental principles of his successful trading philosophy. Always trade with the line of least resistance, which is the prevailing trend. He explains that trying to buck the trend by picking tops or bottoms is a highly speculative and usually losing endeavor. Instead, the smart money waits for the market to clearly establish a direction, whether up or down, and then positions themselves to move with it. He illustrates the folly of constantly trying to buy low and sell high in opposition to a strong trend, equating it to trying to stop a runaway train. Livingston emphasizes that even if one's fundamental analysis suggests a stock is overbought or oversold, the market itself is the ultimate judge. The truly profitable approach is to acknowledge the market's current direction, no matter how illogical it might seem, and align one's trades accordingly. This chapter is a strong affirmation of trend following as a core strategy and a warning against the ego-driven desire to predict reversals. Key takeaways. 1. Follow the path of least resistance. The most profitable approach is to trade in the direction of the established trend. Trying to fight the market's momentum is a recipe for losses. 2. Avoid picking tops and bottoms. Do not try to call the exact peak of an uptrend or the lowest point of a downtrend. These are often ego-driven and highly risky attempts. 3. The market is supreme. Regardless of personal opinion or fundamental analysis, the market's current price and trend are the ultimate reality. Disrespecting the trend is financially dangerous. 4. Patience for trend. Confirmation. Wait for a clear trend to establish itself before entering a trade. Don't rush into a position based on anticipation. Wait for the market to confirm its direction. 5. Letting profits run in the trend. Implied in this chapter is the benefit of allowing profits to accumulate as long as the dominant trend remains intact, rather than exiting prematurely. Chapter 13. Recognizing the signs of a turn. In Chapter 13, Larry Livingston focuses on the crucial skill of identifying when a major market trend is nearing its end or reversing. This is a sophisticated lesson, as he explains that a market doesn't typically reverse abruptly. Instead, there are often subtle signs of distribution at the top of a bull market, meaning smart money is quietly selling shares to the public, or accumulation at the bottom of a bear market. Smart money is quietly buying. Livingston details how to observe price action and volume for these signals, such as a stock failing to make new highs with increasing volume, or a sudden surge in volume on a down day after a prolonged rally. He warns against the common mistake of holding on too long out of hope or buying too early out of a desire to catch the absolute bottom. This chapter emphasizes the importance of objective observation over wishful thinking and outlines how to use the market's own behavior to signal when it's time to adjust one's position or even reverse it. Key takeaways. Trends don't reverse. Instantly, major trends typically don't end with a sudden reversal. They show signs of exhaustion or change over a period through distribution, at highs, or accumulation, at lows. 2. Observe price and volume cues. Livingston teaches to look for specific patterns in price action and volume that indicate a trend is losing momentum. For example, a stock might stop reacting positively to good news, or volume might dry up on rallies. 3. The folly of holding too long. Hoping for an indefinite continuation of a trend can be disastrous. It's crucial to acknowledge the market's signals of a turn and act accordingly, even if it means sacrificing potential small gains. 4. Patience for reversal. Confirmation. Just as with entry into a trend, patience is needed for confirming a reversal. Don't rush to short a market that's just dipped or buy one that's simply bounced. Wait for definitive signs of a new direction. 5. Market leadership changes. He notes that often, the stocks that led a trend will show weakness first when the trend is about to turn, serving as an early warning sign for the broader market. Chapter 14. The Price of Being Right Too Soon. In Chapter 14, Larry Livingston shares one of his most painful and recurring lessons: the significant cost of being right too soon. He recounts instances where he correctly predicted a major market move, but acted on that conviction prematurely, before the market itself was ready to move in that direction. This early entry often led to substantial losses as the stock either moved against him first or simply stagnated, tying up his capital and testing his patience until he was forced out of the position. He emphasizes that anticipating a move is one thing, but profiting from it requires precise timing. The market's action is paramount. It does not care about a speculator's correct foresight if the timing is off. This chapter serves as a powerful reminder that patience is not just about waiting for a clear signal, but also about refraining from acting even when you feel certain, until the market confirms your view with its own momentum. The smart money doesn't just know what's coming. They know when to act. Key takeaways. 1. Timing trumps foresight. Being fundamentally correct about a future market direction is not enough. Without precise timing, being right too soon can be as damaging as being wrong. 2. Patience until confirmation. Even when confident in your analysis, it's crucial to wait for the market to begin moving in the anticipated direction. Acting on anticipation alone often leads to premature entries. 3. Capital preservation. Entering trades too early ties up capital and exposes it to unnecessary risk and drawdown, potentially preventing you from acting when the actual move begins. 4. The market's own pace. The market moves at its own pace and on its own schedule. A speculator must align with this rhythm, rather than trying to force their will upon it. 5. Distinguishing analysis from action. There's a vital distinction between accurately analyzing a potential market move and correctly timing the execution of a trade. The latter is often the more difficult part. Chapter 15. The Unpredictability of Market Manipulation. In Chapter 15, Larry Livingston delves into his experiences with market manipulation through what were known as pools, or syndicates, groups of powerful individuals who would combine resources to control the price of a particular stock. He recounts how he was sometimes invited to join these pools or observe their operations from afar. While he was adept at understanding the mechanics of these manipulations, he also highlights their inherent unpredictability and the significant risks involved. Livingston explains that even well-orchestrated pools could fail due to unexpected market conditions, a lack of discipline among participants, or the sheer scale of the market's natural forces. He notes that the public was often the target of these manipulations, lured in by artificially inflated prices only to be left holding the bag when the pool dissolved. This chapter offers a fascinating glimpse into a less regulated era of Wall Street and reinforces Livingston's core belief. True, sustainable profits come from understanding and trading with genuine market forces, not from attempting to control or manipulate them. Key takeaways. 1. Manipulation is risky and unpredictable. Even powerful groups attempting to manipulate stock prices faced significant risks, and often failed due to unforeseen market conditions or internal disagreements. 2. Public as the target. Market manipulations often preyed on the public's greed and fear, using artificial price movements to draw them in before prices were inevitably crashed. 3. Genuine market forces prevail. Despite attempts at manipulation, Livingston shows that the true forces of supply and demand and broader market trends ultimately dictate prices in the long run. 4. Integrity of trading philosophy. This chapter implicitly reinforces Livingston's preference for trading based on objective market observation and natural trends, rather than engaging in or relying on artificial price movements. 5. Understanding market structure. Even in a manipulated environment, understanding the mechanics of how such schemes operated provided Livingston with valuable insights into market dynamics and human psychology. Part 3. Wisdom from Experience in Masterful Trades. Chapter 16. The Art of Selling Short. In Chapter 16, Larry Livingston shifts his focus to the crucial and often misunderstood practice of selling short. He explains that the principles for making money in a bear market, by selling short, are fundamentally the same as those for making money in a bull market, by going long, but with a critical psychological difference. He emphasizes that the line of least resistance can be downwards just as easily as upwards, and a successful speculator must be equally prepared to profit from declines. Livingston debunks the common misconception that selling short is inherently more difficult or riskier than going long. He argues that fear often prevents people from selling short, even when market conditions clearly call for it. He details how to recognize the signs of a top and the beginning of a bear trend, stressing the importance of being patient for confirmation and then acting decisively. This chapter is vital for understanding that true market mastery involves profiting from both upward and downward movements, free from emotional biases against shorting. Key takeaways. 1. Profiting from declines. Just as profits can be made by buying low and selling high in a bull market, significant gains can be achieved by selling high and buying low in a bear market, short selling. 2. Psychological barrier to shorting. Many speculators hesitate to sell short due to inherent bias or fear, missing out on profitable opportunities during the market downturns. 3. Same principles apply. The core principles of identifying trends, waiting for pivotal points, and exercising patience and discipline are equally applicable to short selling as they are to going long. 4. Recognizing the top. Livingston explains how to identify signals that a bull market is exhausted and a decline is imminent, which are key for initiating short positions effectively. 5. Market does not discriminate. The market offers opportunities regardless of direction. A versatile speculator must be willing and able to trade both sides of the market. Chapter 17. Lessons from the 1907 Panic. In Chapter 17, Larry Livingston recounts one of the most famous episodes of his career, his monumental success during the Panic of 1907. This period provided him with the perfect canvas to apply all the hard-earned lessons about identifying major trends and understanding market psychology, particularly during a significant downturn. While many were losing fortunes, Livingston meticulously observed the weakening market conditions, recognized the signs of impending collapse, and took massive short positions. He details how he stayed calm amidst the widespread panic, trusting his analysis and the market's clear signals of a steep decline. His ability to remain detached and disciplined, even as the financial world seemed to crumble around him, allowed him to accumulate an unprecedented fortune. This chapter serves as a powerful testament to the effectiveness of his developed strategies, patience, observation, and trading with the prevailing line of least resistance, especially during times of extreme volatility and fear. It solidified his reputation as a shrewd and fearless operator. Key takeaways. 1. Profiting from crisis. Livingston demonstrated that significant profits can be made during market panics and crashes by correctly identifying and acting on the downward trend. 2. Discipline. Amidst panic. His success in 1907 was a direct result of his ability to maintain emotional detachment and discipline, while others succumbed to fear and irrational selling. 3. Validation of trend. Following, the panic provided strong validation for his core strategy, recognizing the line of least resistance, downwards in this case, and trading with it aggressively. 4. Observation over emotion. He highlights the importance of objectively observing market conditions and trusting those observations, rather than being swayed by the prevailing sentiment of fear or greed. 5. Capitalizing on big moves. This chapter is a prime example of Livingston's philosophy of waiting for and capitalizing on big moves, as the 1907 panic offered a massive downward trend. Chapter 18. The Psychology of Holding a Position. In Chapter 18, Larry Livingston addresses one of the most challenging aspects of successful speculation: the discipline of holding a winning position and letting profits run. He notes that it's often far easier for speculators to endure a loss than it is to hold onto a substantial gain. The fear that a profit will disappear leads many to sell out prematurely, only to watch the stock continue its upward or downward trajectory, leaving them with regrets and missed opportunities. Livingston emphasizes that once a trade is entered based on sound analysis and a clear trend, the speculator's job is largely to be patient and do nothing unless the market provides a clear signal to exit. He warns against succumbing to the human desire for quick gratification or the fear of seeing paper profits diminish. This chapter reinforces the idea that significant wealth is built not by constant trading, but by having the conviction and patience to stay with major trends, allowing the market to work for you. Key takeaways. 1. Letting profits run is crucial. The greatest profits come from having the discipline to hold on to winning positions for extended periods, capturing the majority of a major trend. 2. Fear of losing paper profits. A common psychological pitfall is selling too early due to the fear that accumulated paper profits might evaporate. This often leads to missing out on larger gains. 3. Patience extends beyond entry. Patience isn't just about waiting for the right entry, it's equally important for holding positions and allowing the market to do its work. 4. No need for constant action. Once a well-reasoned trade is placed, continuous action is often detrimental. The best course is often to simply monitor and avoid interfering with a profitable position. 5. Trusting your analysis and the market. This chapter highlights the need to trust your initial analysis and the market's ongoing signals, rather than succumbing to emotional impulses to prematurely exit. Chapter 19. The Dangers of Diversification and Overtrading. In Chapter 19, Larry Livingston offers a strong critique of both excessive diversification and overtrading. He argues that scattering one's capital across too many different stocks or markets often leads to diluted focus and diminished returns. Instead, he advocates for concentrating capital on a few carefully selected opportunities where the trend is clear and the potential for a big move is high. True success, he explains, comes from knowing a few stocks exceptionally well, rather than having a superficial understanding of many. He also warns vehemently against overtrading, the constant urge to be in the market, making too many transactions or trying to profit from every minor fluctuation. Livingston asserts that this constant activity is a major drain on capital through commissions and slippage, but more importantly, it depletes mental energy and often leads to emotional decision-making. He stresses that patience, waiting for the right opportunities, and then acting decisively on those few strong convictions is far more profitable than continuous, scattershot trading. Key takeaways. 1. Concentration over excessive diversification. Rather than spreading capital thinly across many assets, focus on a few select opportunities where conviction is high and the trend is clear. Too much diversification can dilute profits and make effective monitoring difficult. 2. Overtrading is detrimental. Constant buying and selling, trying to capture every small market movement, is a significant drain on capital due to fees and mental energy. It also leads to poor decision-making. 3. Patience is a virtue. Again, this chapter reinforces the idea that patience isn't just about waiting for entry, but also about the discipline to not trade when no clear, high-probability opportunities are present. 4. Quality over quantity of trades. A few well-researched, well-timed, and patiently held trades offer far greater returns than numerous impulsive or poorly thought out transactions. 5. Focus and conviction. Success in speculation requires intense focus on particular opportunities and strong conviction in one's analysis, which is undermined by spreading oneself too thin. Chapter 20. The Value of Solitude and Independent Thought. In Chapter 20, Larry Livingston underscores the profound importance of solitude and independent thought for successful speculation. He argues that the market is a solitary pursuit, and a speculator must learn to rely solely on their own judgment, free from the influence of others. He warns against discussing trades, seeking advice, or succumbing to the collective emotional swings of fellow traders or the general public. Livingston believes that genuine insights and profitable decisions emerge from quiet, focused analysis, not from bustling trading floors filled with chatter or from groupthink. He emphasizes that the moment a speculator starts listening to others or allows their emotions to be swayed by external opinions, they lose their edge and their ability to objectively read the market. This chapter reinforces the idea that trading is an intellectual and emotional battle fought primarily within oneself, and maintaining mental independence is crucial for victory. Key takeaways. 1. Solitude for clear thinking. Effective speculation requires working in isolation, free from the distractions and emotional biases of other people's opinions or the noise of the crowd. 2. Independent judgment is paramount. Trusting and acting on one's own analysis and convictions, rather than relying on external tips or group sentiment, is critical for long-term success. 3. Avoid market gossip and tips. Engaging in discussions about stocks or seeking advice from others can cloud judgment and lead to poor, emotionally driven decisions. 4. Self-reliance is a core virtue. A successful speculator must cultivate profound self-reliance, understanding that ultimately, they alone are responsible for their decisions and outcomes. 5. Emotional detachment. The chapter reinforces the need for emotional detachment, not just from the market's price swings, but also from the emotional contagion of other participants. Chapter 21. The importance of a clear mind. In Chapter 21, Larry Livingston emphasizes that a speculator's greatest asset is not their capital, nor their analytical tools, but their mind. He argues that mental clarity, emotional control, and a sound psychological state are absolutely paramount for consistent success in the markets. He illustrates how fear, greed, hope, and despair can cloud judgment, leading to impulsive decisions, broken rules, and ultimately, significant losses. Livingston stresses that the market is a relentless taskmaster that punishes emotional trading. He advocates for maintaining a disciplined approach, not just in executing trades, but in the mental preparation and self-management required to withstand market pressures. This chapter powerfully conveys that the battle in trading is primarily internal. Conquering one's own emotional weaknesses and maintaining objectivity are far more crucial than any external market factor. A clear mind, free from bias and emotional turmoil, is essential for truly reading the tape and making rational decisions. Key takeaways. 1. Mindset as a primary asset. A speculator's psychological state and mental clarity are more valuable than capital or technical skill. The internal game is often more challenging than the external market. 2. Emotional control is critical. Emotions like fear, greed, and hope actively distort judgment and lead to poor trading decisions. Mastering emotional responses is a continuous, vital effort. 3. Discipline extends to self-management. Discipline isn't just about trade execution. It's about maintaining a disciplined mental state, resisting impulses, and adhering to one's rules even under pressure. 4. Objectivity is key. To truly read the market, one must be completely objective, free from personal biases or emotional attachments to positions. 5. The internal battle. Success in trading is primarily a battle against one's own human nature and emotional weaknesses. Winning this internal fight is fundamental to winning in the market. Chapter 22. Observing the behavior of the public. Summary. In Chapter 22, Larry Livingston returns to his astute observations of the general public's behavior in the stock market. He reiterates and deepens his analysis of how the amateur speculator consistently loses money due to their predictable, emotional reactions. He notes that the public is often late to major trends, buying enthusiastically only after prices have already run up significantly, and selling in despair at market bottoms. Livingston highlights the public's tendency to chase hot tips, believe optimistic narratives at the top, and panic at the first sign of trouble. He contrasts this with the disciplined, detached approach of the professional speculator. This chapter reinforces that the market provides consistent opportunities for those who can remain objective and avoid the herd mentality. The public's irrationality, driven by hope and fear, creates the very fluctuations that a shrewd operator can capitalize on. He stresses that while instruments and technologies may change, human nature remains constant, meaning these behavioral patterns will persist. Key takeaways on public's predictable mistakes. The general public consistently makes the same errors, buying near market tops out of greed and fear of missing out, and selling near market bottoms out of panic and despair. 2. Herd mentality is dangerous. Following the crowd's emotional swings leads to consistent losses. Success often comes from acting contrary to widespread sentiment. 3. Human nature is constant. Despite evolving market mechanisms, the underlying emotional drivers of human behavior in financial markets remain unchanged, making these observations timeless. 4. Opportunity in irrationality. The public's irrationality creates the volatility and price movements that professional speculators can exploit through disciplined trading. 5. Detachment from public opinion. A key to success is to remain completely detached from popular opinion and market chatter, relying instead on objective observation of price action. Chapter 23. The Timeless Nature of Speculation. In Chapter 23, Larry Livingston reflects on the enduring principles of market speculation, emphasizing that while the instruments traded and the technologies used may change over time, human nature remains constant. He argues that the underlying forces of greed, fear, hope, and impatience continue to drive market participants to make the same old mistakes, regardless of the era. Livingston asserts that the fundamental laws of supply and demand and the psychological reactions of the public to price movements are immutable. Therefore, the lessons he learned through costly experience, such as the importance of patience, discipline, independent thought, and trading with a line of least resistance, are timeless. This chapter offers a powerful message of reassurance that serious students of the market can always find an edge by understanding these unchanging human elements, rather than getting caught up in the transient specifics of any given market cycle or technological innovation. Key takeaways. 1. Human nature is immutable. The core psychological drivers of market participants, greed, fear, hope, and impatience, remain constant across generations, making behavioral patterns highly predictable. 2. Timeless market principles. Despite changes in technology and financial instruments, the fundamental laws of speculation, such as supply and demand, and the importance of discipline, endure. 3. Lessons remain relevant. The hard-won lessons about patience, emotional control, and independent thinking are as vital today as they were in Livingston's time. 4. Focus on the fundamentals. Speculators should focus on understanding the unchanging underlying forces and human behaviors in the market, rather than getting distracted by fleeting fads or new technologies. 5. History repeats itself, psychologically. While market conditions evolve, the psychological traps and opportunities presented by human behavior in the market tend to repeat over and over again. Chapter 24. The Unending Battle with Oneself. In the final chapter, Larry Livingston brings his narrative to a powerful conclusion, emphasizing that the greatest challenge and the most crucial battle for any speculator is not against the market itself, but against one's own internal nature. He asserts that despite all the knowledge gained about reading the tape, understanding trends, or recognizing pivotal points, the ultimate determinant of success or failure lies in the speculator's ability to control their own emotions. Fear, greed, hope, and impatience. Livingston admits that even with all his experience, this internal struggle is a constant, unending fight. The market, in his view, is a mirror reflecting a speculator's weaknesses. True discipline comes from adhering to a well-thought-out plan, cutting losses quickly, letting profits run, and above all, waiting patiently for the right opportunities, free from emotional interference. This chapter serves as a poignant reminder that speculation is a journey of self-mastery, a psychological test that requires continuous vigilance and an unwavering commitment to one's rules, irrespective of external pressures or internal temptations. Key takeaways. 1. The internal battle is paramount. The most significant challenge in speculation is mastering one's own emotions and psychological impulses, not outsmarting the market. 2. Self-discipline is the ultimate edge. All other knowledge and skills are secondary to the unwavering discipline required to stick to a plan, manage risk, and control emotional reactions. 3. Human weaknesses are the greatest threat. Greed, fear, hope, and impatience are the primary drivers of irrational behavior and are responsible for most trading losses. 4. Continuous self-improvement. Even for experienced speculators, the fight against one's own human nature is an ongoing process that demands constant vigilance and self-awareness. 5. Adherence to rules. Success hinges on developing a robust set of trading rules and having the unwavering commitment to follow them, especially when emotions tempt you to deviate. All right, PowerBooks community, that brings us to the close of another incredibly insightful exploration, this time into the timeless wisdom of Reminiscences of a Stock Operator by Edwin Lefèvre. I trust you've gleaned some invaluable insights into the enduring principles of speculation, the psychology of the market, and, most importantly, the crucial battle within ourselves. If you found this breakdown illuminating and are eager to delve even deeper into Larry Livingston's, Jesse Livermore's hard-won lessons on patience, discipline, and understanding market trends, then let me know in the comments below. If there's enough interest, I'll be sure to include a link to the full book in the description for you to explore every nuance. And if this summary has empowered you with a new perspective on the markets, please hit that like button to help us share this knowledge with more individuals striving for success. Don't forget to share this video with your fellow traders and investors who are looking to gain a deeper understanding of market dynamics and the human element behind them. Of course, to continue fueling your journey with more powerful book summaries on self-development, business, investing, trading psychology, and more, make sure you subscribe to PowerBooks and ring that notification bell so you never miss our next deep dive. Your thoughts and questions are invaluable, so please comment below with your key takeaways or any aspects of Reminiscences of a Stock Operator that resonated with you. Remember, here at PowerBooks, we know that knowledge is not power. The application of knowledge is power. So take these insights, apply them to your understanding of the markets, and strive for that powerful edge. Thanks for tuning in. Stay curious, keep learning, and we'll catch you in the next powerful book breakdown.